Today, we're diving into corporate transactions, focusing specifically on mergers, acquisitions, and hostile takeovers. These are the key ways companies combine forces, compete to take control, and navigate the complex landscape of regulatory oversight. Understanding these processes is essential because they reshape industries and influence market dynamics. In this first lesson, we'll explore the fundamentals of M&A, laying the groundwork for everything that follows. A merger is essentially the combination of two companies into a single legal entity. This process usually involves a negotiated transaction designed to bring together ownership, operations, and control under one unified structure. Key to understanding mergers are a few characteristics. First, the merger must be approved by the boards of both companies. Second, there is only one surviving enterprise after the merger, meaning the companies fully integrate rather than just cooperating. Third, management and assets are combined to operate as a single entity moving forward. When it comes to the types of mergers, there are three common categories. Horizontal mergers happen between companies in the same industry, typically competitors. Vertical mergers involve companies at different stages of the supply chain, like a manufacturer merging with a supplier. Lastly, conglomerate mergers combine firms from unrelated business areas, broadening the company's scope. Understanding these basics gives us a solid foundation for exploring mergers in more detail. When we talk about corporate transactions, one key concept is an acquisition. So what exactly is an acquisition? Simply put, it happens when one company buys enough of another company to take control of its business assets and operations. Now there are two main parties involved in this process. First, we have the acquired party, often called the target company. This is the business being purchased. The shareholders of the target company typically receive payment. This could be in cash, stock, or sometimes a mix of both, in exchange for giving up their ownership. On the other side, we have the purchasing party, known as the acquiring company. This company initiates the purchase because it wants to gain control, achieve strategic advantages, or grow by integrating the target company into its existing operations. Essentially, the acquiring company is looking to strengthen its position by bringing in new resources or capabilities through this acquisition. When comparing mergers and acquisitions, it's important to understand that although both involve combining companies, they lead to different legal outcomes. In a merger, two companies come together to form a single new entity. This usually means the separate identities of the original companies disappear. On the other hand, an acquisition occurs when one company purchases another. In this case, the acquired company may continue to exist as a subsidiary. From a structural perspective, a merger results in one unified company, whereas in an acquisition, the buyer remains intact and absorbs the target. Regarding approval, mergers typically require shareholder votes to move forward, reflecting the need for agreement among both parties. Acquisitions, meanwhile, are often completed through a stock or asset purchase, which can sometimes be more straightforward. Control is another key difference. Mergers are framed as negotiated combinations, usually friendly arrangements, though acquisitions can either be friendly or hostile depending on the circumstances. Understanding these distinctions helps clarify the strategic and legal implications behind these two paths to combining businesses. In corporate transactions, particularly mergers and acquisitions, there are 6 key stages that guide the process from the initial intent through to full integration. First, we have the planning phase, where the groundwork is laid, objectives are set, and strategies developed. Next comes due diligence, a crucial step involving detailed investigation and analysis to assess risks and opportunities. The third stage is negotiation, where the terms are discussed and agreed upon by the involved parties. Following negotiation, the deal moves to the approval stage, which often requires sign-offs from senior management or regulatory bodies. Once approved, we enter the financing phase, where the necessary funds are secured to execute the transaction. Finally, the last stage is integration, which focuses on combining the entities smoothly to realize the intended benefits. Understanding this sequence provides a clear framework for managing M&A transactions effectively. Now, Let's dive into the first stage of the M&A process, planning and strategy. This is where everything begins, and frankly, it's the foundation for a successful deal. The key here is to define a clear strategic objective. Without knowing exactly what you want to achieve, moving forward is like shooting in the dark. Next, you need to identify the right target or partner. This means finding an organization that aligns well with your goals and values, ensuring a good fit not just financially but operationally and culturally. Then, it's crucial to assess your financing capacity. Understanding how much you can realistically invest and what resources you have helps shape the scope of the deal and keeps things within practical limits. Finally, anticipate potential integration challenges early on. Thinking ahead about how the two companies will merge operations, systems, and teams can save a lot of trouble down the line. Remember, strong deals always start with a clear strategic rationale long before the price is discussed. This stage is about building that solid foundation, setting the stage for everything that follows. Now, moving on to stage 2, which is the due diligence phase. This is a critical step where buyers take a deep dive into the target company's financials, contracts, liabilities, operations, and any legal risks involved. The goal here is to confirm the true value of the business, uncover any potential issues that might not be immediately apparent, and make an informed decision about whether to proceed with the deal, renegotiate terms, or walk away entirely. Essentially, this stage is all about review, verify, and reveal, ensuring that nothing is overlooked before moving forward. When we talk about due diligence, we're really looking at several key areas that need thorough investigation. First, the financial aspect. This involves examining the quality of earnings, understanding the debt levels, cash flow, and reviewing forecasts to get a clear picture of the company's financial health. Next is the legal area, where we assess contracts, any ongoing or potential litigation, permits, and overall compliance to identify any legal risks. Then there's the tax component, which requires us to look into liabilities, filings, audits, and how the transaction is structured from a tax perspective. Moving on to operations, we focus on systems, supply chains, efficiency measures, and the risks involved in integrating with existing processes. Market analysis is crucial too. We study customers, competition, pricing power, and growth potential to understand market positioning. Finally, the human resources area is about evaluating key talent, incentive structures, benefits, and ensuring cultural fit. Reviewing these 6 areas thoroughly helps us manage risk and make informed decisions throughout the due diligence process. Now, let's talk about pricing the deal, which is a crucial part of stage 3, valuation and negotiation. It's important to understand that value is not just a single number. Instead, it's a range that we test against market conditions, past transactions, and expected future cash flows. There are 3 core approaches to determining this value. The first approach is comparable companies. Here, we benchmark the target company against similar public firms by using valuation multiples like EBITDA, revenue, or earnings. This gives us a market-based perspective on value. Next, we look at precedent transactions. This approach examines prices paid in previous acquisitions of comparable companies. It also accounts for any control premiums that buyers have been willing to pay historically. Lastly, we have the discounted cash flow method, or DCF. This technique values the business based on projected future cash generation, adjusting for both timing and risk factors to arrive at today's value. Together, these methods cover market, deal, and cash flow perspectives, helping us arrive at a well-rounded and justifiable valuation range. Companies involved in the deal must submit pre-merger filings and observe waiting periods before the transaction can close. During this waiting period, agencies like the Department of Justice or the Federal Trade Commission conduct a detailed review of the deal. Depending on their findings, they might require remedies. This could include divestitures or, in some cases, blocking the transaction altogether to protect market competition. It's important to keep in mind the Hart-Scott-Rodino threshold here, which is a key trigger point. If a transaction exceeds this threshold, it must be reported to regulators before it can be finalized. This step ensures that any potential anti-competitive risks are addressed early in the process. This stage of review is crucial to maintaining a fair and competitive marketplace. When we look at antitrust considerations in mergers and acquisitions, the main concern is whether the deal will give the combined company too much market power. Essentially, antitrust law is focused on preventing a situation where competition is stifled. This could lead to higher prices, less innovation, or fewer choices for consumers. One key point to understand is market concentration. This happens when competitors disappear or one firm gains control over a large share of the market, which can create an uneven playing field. Regulators will closely examine how the companies overlap in terms of products, geographic reach, and any barriers that might prevent new competitors from entering the market. Deals that pose a high risk to competition often require specific remedies, such as divestitures, or in some cases, they might be blocked entirely. So, the core question antitrust authorities ask is, will this deal weaken competition? This is a critical lens through which all potential mergers and acquisitions are evaluated. A hostile takeover occurs when an acquiring company tries to gain control without the approval of the target company's board. Unlike friendly deals, where management negotiations lead to agreement, here the bidder bypasses the board entirely. In these situations, the board usually resists the takeover attempt, refusing to approve it. The bidder's primary strategy involves going directly to the shareholders to convince them, or launching a proxy fight to replace the board with members more favorable to the takeover. Because there is inherent conflict in hostile takeovers, cooperation is replaced by confrontation. As a result, defense tactics become crucial for the company under threat to maintain control and protect its interests. This dynamic highlights the intense power struggle at the heart of hostile takeovers. When we talk about control battles in the corporate world, we're focusing on hostile takeover strategies, methods used to gain control of a company against the wishes of its current management. There are 4 common paths to achieving corporate control. First is the tender offer. This involves making a bid directly to the shareholders to buy their shares, usually offering a premium to encourage them to sell. Second, the proxy contest, where the challenger solicits votes from shareholders to replace existing board members, effectively taking control of the board and influencing company decisions. Third is the bear hug strategy, which is a very public offer that puts pressure on management to seriously consider the takeover proposal. And lastly, the creeping acquisition, where the buyer gradually buys shares quietly over time, slowly building up influence without triggering immediate alarms. Each of these paths represents a different tactical approach to hostile bids, and understanding them is essential in studying corporate control battles. One common defense strategy against hostile takeovers is called the poison pill. Essentially, this strategy allows existing shareholders to buy additional shares at a discounted price if an acquirer surpasses a certain ownership threshold. The key trigger is when a bidder acquires more than a specified percentage of the company's stock. At that point, the mechanism kicks in, giving other shareholders the right to purchase more shares at a discount. This dilutes the bidder's ownership and makes the takeover much more expensive and complicated. Ultimately, the poison pill puts pressure on the bidder to negotiate with the board or consider alternative options, protecting the company from an unwelcome takeover. When a company faces a hostile takeover bid, there are 2 classic defense strategies they often use: golden parachutes and white knights. Golden parachutes are designed to protect key executives by making the takeover more expensive for the bidder. Essentially, these are contracts that guarantee large payouts, like severance packages, bonuses, and accelerated benefits, to important leaders if they lose their jobs after a change in control. This increases the overall cost of the acquisition and can deter the hostile party from proceeding. On the other hand, white knights involve inviting a friendlier buyer into the picture. Management seeks out a more acceptable acquirer, one who aligns better with the company's strategic goals, leadership, or culture. This friendly rival then makes a competing offer that can effectively replace the hostile bid, safeguarding the company's interests. In summary, these strategies either raise the cost of control or bring in an ally to defend against unwanted takeovers. Both aim to protect the company's long-term vision and stability during a turbulent takeover attempt. Now let's talk about takeover defenses, focusing on recapitalization and asset sales. When a company faces a potential takeover, it can restructure its debt and equity to make itself more expensive or less appealing to the bidder. This process is known as recapitalization. Essentially, the target company rearranges its financial structure to deter unwanted acquisition attempts. Another strategy is asset sales, where management sells off the company's most valuable or crown jewel assets. By doing this, the acquirer can't easily gain control of the company's key operations, reducing the incentive for the takeover. Both recapitalization and asset sales are ways to reshape the company's balance sheet or its asset base to strengthen its defenses. These strategies are crucial parts of any takeover defense playbook, helping management maintain control and protect shareholder value. Now let's dive into the key defense strategies companies use to fend off unwanted takeovers. These legal and structural defenses are designed to make a takeover more difficult, slower, or costly for a potential acquirer. First, we have the staggered board. In this setup, directors serve overlapping terms, which means an acquirer can't replace the entire board all at once. This slows down efforts to gain control quickly through board changes. Next are supermajority requirements. These corporate rules demand an unusually high percentage of shareholder votes to approve significant actions like mergers or changes in control. This makes it harder for a bidder to push through a takeover without broad shareholder support. The third strategy involves what's called the crown jewels. Here, management may sell or threaten to sell key assets, making the company less attractive or less valuable to the potential buyer. It's a way to deter the acquirer by reducing what's at stake. Finally, litigation is another defense tactic. The target company can initiate legal action to delay the bid, challenge disclosures, or contest the bidder's tactics under corporate or securities law. This legal pushback can buy time and complicate the takeover process. All these measures together form a robust line of defense, giving the target company leverage and options to protect itself against hostile takeovers. Now, let's talk about the Hart-Scott-Rodino Act, or HSR Act, which plays a crucial role in regulatory review for mergers and acquisitions. The HSR Act requires companies to provide advance notice for certain deals before they can be finalized. This means that for qualifying transactions, pre-merger filings must be submitted prior to closing. The baseline size of transaction threshold that triggers this requirement is roughly $126.4 million, and this figure is adjusted annually. Once the filing is made, both the Federal Trade Commission and the Department of Justice receive it and may investigate any potential competitive effects the merger might have. An important aspect to note here is the possibility of a formal second request, which significantly extends the review period beyond the initial waiting window. Typically, parties must wait at least 30 days after filing before they can close the deal. Closing early or neglecting to file can result in hefty civil penalties, sometimes exceeding $50,000 for each day of noncompliance. Understanding these timing requirements and penalties is essential for navigating the regulatory landscape effectively and avoiding costly missteps. Here we have a real-world example that illustrates the complexities of modern mergers and acquisitions. In 2023, Microsoft acquired Activision Blizzard, a major player in the gaming industry with popular franchises like Call of Duty. This deal was significant not just because of its size or the content it brought under one roof, but also due to the intense scrutiny for regulators around the world. Regulators were concerned about whether Microsoft could use this acquisition to limit competitors' access to key games or cloud distribution platforms, which would give Microsoft significant antitrust leverage. Ultimately, after a prolonged review process, the deal was approved, demonstrating how these transactions today are heavily influenced by concerns over market power and competitive dynamics, not just the purchase price. This case highlights how scale and content control can impact the regulatory landscape, making it a powerful example of how platform power and antitrust issues are central to M&A decisions in the tech and gaming sectors. To wrap up, let's review the key takeaways from our lesson. First, strategy is crucial because it sets the logic behind any deal, guiding why and how it should happen. Due diligence is equally important. It helps us uncover the true price, assess risks, and determine whether the deal is a good fit for all parties involved. Next, antitrust review plays a significant role, as it can either delay the process or even block combinations that may harm competition. Hostile takeovers are another aspect to understand. These attempts to gain control happen without the board's support and can create tension. Finally, defenses are tools that companies use to buy time, improve their leverage, and strengthen their negotiating position. All these elements together shape the complexity and strategy behind deals.